Hey, it's Stuart. So you've asked me how would I construct a portfolio of ETFs? Well, of course, I can't give you financial advice on YouTube because I don't know your personal circumstances. So, to some degree, it may or may not be appropriate to your circumstances. But I thought I would still answer the question because it'll give you a sense of how we might go about constructing an ETF portfolio to gain exposures to certain geographical markets using different indexing strategies for those markets. Now, of course, this is a point in time analysis, and my answer might change 6, 12 months from now because the market could be different in terms of risks and opportunities. So I'm telling you this just to warn you. Don't necessarily go away and implement this list. It may or may not be appropriate. So I guess if I'm going to construct an ETF portfolio, I'm going to think about, how much do I want in the Australian market, in international markets, and then in perhaps emerging markets and even smaller companies. So I would probably aim for about 30 to 40% in Australia. And I'd probably use 4 different exposures for that. I'd have some traditional market cap indexing, which is VAS. That's a Vanguard ASX 300 index. I would use some fundamental indexing, which is QOZ, QOZ. It's a BetaShares product that uses fundamental indexing, so breaking the link with price. I would also invest some money in Dimensional, which is kind of like a value fund. They've got a long track record, and certainly value is relatively cheap now. The Australian ETF is DACE, that's the code. And I would throw in some smaller company exposure as well in Australia, VOS, just a little bit of that to round out the Australian exposure. So, look, maybe I'd put 30% in VAS, 30% in QOZ, and 30% in DACE, and then 10% in VSO, for example. That would make up 30-40% of my allocation. 40 to 50% would go into international markets, and I would use probably 4 ETFs for international markets, and I'd probably put a quarter in each of them. So QUS is an equal weight S&P 500, just to still get access to the US market, particularly small and mid cap, but not have the exposure to the large dominant large cap stocks. I would have VLUE, which is a global value fund. So again, you're going to get some more US exposure there, and potentially more large cap US exposure as well, but on a value basis. VEU, which is all world excluding US and includes a little bit of emerging markets as well, but it's going to give you greater exposure to Europe, UK, and Japan, which I don't think is such a bad idea. And then I'd round it out with a hedged dimensional product. So again, a value manager. DGCH is the code for the Dimensional Global Hedged Fund. So I said that's my international exposure, 40-50% of my overall portfolio in that. And again, what I'm trying to do is accommodate the geographical markets that I think are exhibiting, based on long-term fundamentals and trends, the best possible returns in the future, or probability of delivering above average returns in the future, and skewing away from the large cap US tech. And the remaining, say, 10 to 15% of my portfolio, I would put in emerging markets and smaller companies. So for smaller companies, I like QHSM. It's a VanEck product, which is a small company's quality. And if you have a look at the past returns, that's pretty good. So I'd probably put, maybe 7-ish% of the portfolio in that, and then 7 to 10% in emerging markets. And I like any one of 4 products I can kind of reel off. Again, another VanEck product is EMKT. That's pretty good. traditional Vanguard emerging market, which is VGE. I really like BetaShares Tech Tigers product, which is an Asian tech product. The reason I like that is one thing technology likes is scale, and there's no better scale than almost 1.4 billion people in China. That ticker code is Asia, ASIA. And Fidelity also has a Asian fund as well. That's FASI. So that kind of rounds out the exposure. So we're probably investing in about 10 ETFs there. And the proportions, as I said, might change over time in terms of what the market might be doing. But if you ask me today, that's my answer today. Again, of course, it's not personal financial advice, but hopefully it gives you a bit of food for thought and a bit of a flavor for, how we might construct an ETF portfolio. Cheers.